Ladies and gentlemen, welcome again to another new lesson at TradAfrica. My name is Samuel Ngan. Today, we're going to talk about trading, long and short positions, their meaning, including the risk. When talking about short or long in the financial market, many people think that going short means holding something for the short amounts of time, or going long means holding something for a long period of time. What about you? What do you think going long or short means? Does it have anything to see with the time frame? Well, let's see the exact meaning of long and short in any financial industry. First, we should understand that going long or short does not have anything related to the time frame. Going short, in its simplest definition, is the way to make money when something is going down in price, which means selling a security today and wait to make money when the price drops. This can be applied to forex, future, options, crypto, and stocks. But many people, especially those who are new in the market, only know that you must buy low and sell high, which is the definition of long position. Meaning, buying a security today and wait that the price goes up and sell for a profit. This is true because going long is the universal understanding of the market. But when you get more advanced and you start going more deeper, you will understand that you can make money in both ways, regardless of what the market is doing. You can make money when the company is healthy and when the company is crashing. But how does it work, ladies and gentlemen? So, let's go through a practical example to examine how the strategy of long and short positions works and the risk it poses. Imagine you have two investors who decide to take opposite position investing in certain company. The company's stocks currently has a market price around $10. Investor A decide to buy 1,000 shares of these stocks, meaning investing $10,000 of his money. While investor B decide to short 1,000 shares of the same stocks. That means selling $10,000 worth of investment from his broker. Now, the question you can ask yourself is, how is it possible to sell a stock that you don't own? Well, generally, the process involves selling borrowed stocks. For example, in the brokerage account, you can often sell a position by borrowing a stock from your broker and then shorting the stock, meaning selling the stocks. The money you make from the sale obviously doesn't really belong to you, since you sold someone else stocks to get profit if the price drops. But eventually, when you buy the stock or security back known as covering your position, you'll be able to return the stock and keep whatever money is left over, if there is, which is how you profit from the trade. So, let's go back to our example. The stock price fall from $10 to $5. Investor A will lose $5,000 while investor B will gain $5,000. Since investor B will be able to buy the stock back for a lower price and keep the remaining sell money. If the stock price increase from $10 to $15, investor A will be up $5,000, while investor B will be down $5,000. But this raises another important question. How is investor B going to buy back the stock for more money than what is in its account? Since the stock now costs $15 a share and he needs 1,000 shares to give back to his broker, well, this is where the concept of margin come into play. You see, to short a position, investor B needed to previously post what's known as an initial margin of at least 50% into his account. This means that investor B will have contributed $5,000 of his own fund at the beginning of our example to accommodate for any losses. That amount still belongs to investor B, but it's held as collateral or deposit by the broker to ensure that investor B can afford to buy back this in the future. Investor B will also be responsible for what is known as margin call, a process that occurs when the margin becomes insufficient. For example, in case the share price rises from $10 to $15, investor B will receive a margin call to reload his deposit based on what known as the maintenance margin, since there is no more wiggle rooms in the account to accommodate for further losses. So, another big difference between shorting and going long positions is that you can only shorten a margin account. While this has its downside, it does add leverage to the investor's return. What does this mean? Well, let's go back to the example. Let's assume that our share price falls from $10 to $5. This will lead investor A to lose $5,000, whereas investor B will gain $5,000. These gains equal one another, but on the percentage basis. Consider margin, they are quite different. You see, investor A has lost approximately 50% of his investment. But since investor B has only contributed $5,000 of his own money to this margin, it gains 100% of his investment, double the percentage of investor A. Because borrowing is involved with shorting, investor B will see his return increase. Though this goes both ways, percentage losses in the short position will be double what they might have been for investor A. So, what will decline a 50% for investor A will be translated into 100% decline for investor B. Therefore, short position not only twist the percentage return received by investors, but they also amplify them both on the way up and down. But here is where we get into a clear disadvantage of a short position. Specifically, short position come with unique costs that long trader or investor won't face. For example, if the stock you borrow pay dividends, you will actually need to pay this amount to your broker, meaning that you will face a cost equal to whatever dividend the stock pays. The broker also charges investors an interest rate on the value of the stock you borrow. After all, since you are borrowing and shorting someone else's security, you need to indemnify them in the same way that you will indemnify a bank with interest on a loan. Typically, the rate charged on the short position can range anywhere from 2 to 25%, but it can be higher for what are known as hard to borrow stocks, very volatile or small cap position. That is to say that shorting the stock can be quite more expensive than a simple long position due to the interest. But that can be reasonable since you are taking a leverage position and since you are trying to inverse the return for a long position. But there are more disadvantages involved with the short strategy, some of which may be discouraging. The idea of short and hold strategy faces what known as buy-in risk. The chance that a broker will make you prematurely cover your position. This can happen for many reasons. 1. A broker may need to return a stock to the portfolio they took it from. 2. The stock may simply see a surge in demand, but the end result is that you may be forced to close your position at any time. When shorting a position, you may experience what known as a short squeeze, when a heavily shorted stock see its price surge because the investors shorting the stocks need to cover their positions. These investors who short the stocks have shorter time frame than long investors. There are chances that they buy back the stock around the same time, which can lead to a surge in the price and make it harder for you to cover your own position without having a loss. With our two investors, long and short the $10 stocks, we face two risk reward profile. On the one hand, investor A can probably earn an infinitely high return. The $10,000 investment in the $10 stock could double, triple, quadruple in value. As the stock price climbed to 20, 30, 60 or higher. On the downside, the most he can lose if the money is invested. The $10,000, which will only happen if the stock falls to zero, a tragic outcome. Now, investor B, however, flips the risk reward here. If the stock drops down to zero, he can achieve a 200% profit since he's able to keep the $10,000 profit from his $5,000 investment. On the other hand, if the stock, let's say, climb to 20, 40, 60 or higher, he can lose 200%, 400, 600, 800 or more. This means that he can lose a lot more money than what he has initially invested and even own his broker. Indeed, this has had a devastating impact on investors. This is why many investors tend to stick with long only. For many, the return is simply not worth the risk. And on top of the fact that you're going against the natural upward bias of stocks, you're more or less bidding against the company that is working trying to prove you wrong. Nevertheless, short selling certainly does play an important role in the world of investment. Indeed, you can make a lot of money by shorting a declining stocks or company. Or if you want to stay away from the risks that come with a short position, you can just prefer going long, which is a natural upward buy of stocks. Ladies and gentlemen, we hope this information will help you understand what long and short position are. If you still have some questions about this lesson, please contact us through our website www.TradAfrica.com. I look forward hosting you in our next study course, which will talk about how to place your first trade and different type of order you will need for your entry. Thank you for watching and goodbye.